At Farms.com Risk Management, we understand that commodity price risk management and sound financial advice are essential in today's volatile crop and swine sectors. Visit our website at www.riskmanagement.farms.com.
Welcome to the Farms.com Daily Market Commentary for November 28th, 2011. This is Michelle Lamarant, Commodity Research Analyst for Farms.com Risk Management. Strong demand generated by high crude oil prices made 2011 a profitable year for ethanol producers, despite high corn prices in which is normally a thin margin industry. Aided by the recent drop in commodity prices, ethanol margins have been particularly strong in recent months, with Iowa State University reporting that the average ethanol plant cleared a margin of 46 cents per gallon on ethanol production through October. As you can see in front, we have overlaid the January 2012 ethanol daily futures chart with the January 2012 crude oil daily futures chart and the December 2011 daily futures chart, and you can see the growing disparity between ethanol prices and corn prices per bushel. However, multiple headwinds facing the industry threaten to erode current profitability levels. Ethanol producers are expected to lose about 25 cents to 30 cents per gallon on operating profits when the blender's tax credit goes away after December 31st. In trade last week, the December futures price for ethanol had held steady around $2.55 per gallon last week, which was similar to the price of crude oil, while the January contract fell to $2.23 per gallon. Ethanol margins are expected to tighten once the blender's credit goes away, but the impact would be more of a demand issue as the 45 cents per gallon tax credit went to oil refiners, pipelines, and fuel distributors, not ethanol plants. However, the anticipated lower pricing is not necessarily a bad thing, as demand is higher for ethanol when it is priced below gasoline, giving retailers an incentive to offer it as a lower cost gasoline. More crucial to maintaining demand is a federal renewable fuel standard passed by Congress in 2005, which requires the use of more than 13 billion gallons of ethanol in 2012. The amount of ethanol required by the renewable fuel standards is under attack by a recent proposal that would reduce the amount of ethanol required by the Act when corn supplies are tight. Ethanol production would face a 25% reduction when the corn stocks-to-use ratio is 7% or less, and a 50% reduction would occur when the stocks-to-use ratio is 5% or less. The proposal is more worrisome to the ethanol industry than the removal of the blender's tax credit, as the tax credit helps determine what the price of ethanol can be relative to gas, but the renewable fuel standards means ethanol will either be or will not be demanded. JP Morgan believes that if this new bill is passed, it could lead to a significant drop in corn prices. However, the bill is not expected to pass anytime soon because in 2011, a Senate version has not been introduced and the upcoming holiday season is fast approaching. While remaining a headline risk to the industry, the bill is also unlikely to pass in 2012 due to the U.S. elections. The earliest that we anticipate this mandate coming into effect is 2013 or 2014. So bottom line, as long as gas prices remain high, so will the demand for ethanol. It's unlikely that the USDA will further reduce the current 5,000 million bushel corn usage for ethanol allotment in the upcoming WASI reports. Particularly as crude oil prices continue to rise and the European Union and U.S. economies and outside markets could likely surprise to the upside in a relief rally in coming months as policymakers provide the necessary fixes to solve their global debt problems. With ethanol now representing 41% of total U.S. corn usage, the likelihood is that demand could increase, not drop in 2012. We need to worry more about feed and export demand, but we are closer to the end of demand destruction than the beginning, as the USDA has reduced corn demand since July of 2012 by 890 million bushels, and we're not even in a recession compared to 2008 when we saw the USDA reduce demand by 1.1 billion bushel. U.S. corn-based ethanol has become far less costly than Brazilian ethanol, which is mostly made from sugarcane. According to the USDA, the U.S. exported more ethanol in the first 5 months of 2011 than it did for all of 2010, which was also a strong year for ethanol exports. In other news, commodities moved higher today on reports that the International Monetary Fund, or IMF, is putting together a $600 billion rescue package for Italy after Belgium, Hungary, and Portugal all received credit downgrades on Friday. Russia's stronghold on the global wheat export market may soon begin to slip thanks to a new batch of low-priced Argentine wheat. According to reports, at least 1.4 million metric tons of additional wheat will be approved on Tuesday for export. Argentina has recently become the world's lowest cost exporter, with wheat coming to approximately $15 per ton cheaper than the Black Sea supplies at the latest Egyptian tender. However, with freight costs to Egypt at $25 per ton higher than Russia, Argentine wheat remains uncompetitive on the large Egyptian market. The Organization for Economic Cooperation and Development sees Germany, the European Union's largest economy and exporter, slipping into a slight recession in the fourth quarter of 2012, but still expects the overall 2011 GDP at a plus 3% pace and expects growth to pick up further in 2012. A Russian private analyst group forecasts the country's November wheat exports at 2.1 million metric tons and then falling to 1.3 to 1.4 million metric tons in December. The group attributes a forecasted decline in export volume in the latter half of the marketing year as world export market prices fall. As of November 28th, the Russian Egg Ministry estimates the total grain harvest at 97.8 million metric tons. This is up from last year's 63.7 million metric tons, but below 2009's level. The wheat harvest is currently pegged at 59.5 million metric tons, barley at 17.7, and the corn harvest at 5.8. Weekly grain inspections for the week ending November 24th showed that wheat inspections were above expectations at 15.392 million bushels. Corn was also above expectations at 30.596 million bushels, and soybeans disappointed, lower than expectations at 41.4 million bushels. Private grain analyst AgroConsult estimates new crop Brazilian soybean size at 74.8 million metric tons, 1 million metric ton higher than their previous estimate. Canola quality losses have likely occurred in Australia due to persistent rains. The crop was maturing and was supposed to have been harvested during the past week, but additional damage is possible as more rains are expected to return later this week. Analysts are expecting packer bids to be steady to 50 cents higher today, as demand is expected to be strong throughout this week. The pork carcass cutout value gained 38 cents per carcass on Friday to finish at $89.70 per carcass. All ham values are expected to be firm this week as the industry moves into peak holiday production. That's all for today. Have a nice day.